What a week we've just had in the market. Lots of green. Pretty much every company is up and fairly significantly. And one of the reasons was at the start on Monday, we saw that both US and China finally came to the table, although it was only in essence a 90-day pause, and during that time they have agreed to cut down the tariffs for the large part around the 10% point. And then we also saw that the President Donald Trump had his first official trip, which a release from the White House, as is noted here, does show a lot of investment into the country. In fact, we see over $2 trillion, 600 of that coming from Saudi Arabia and 1.2 trillion coming from Qatar. That has helped bolster the market, especially for the likes of Nvidia, which will benefit significantly as a lot of this growth is into artificial intelligence. But there has been one company just this week that has been absolutely hammered down, and that is United Health, down over 23%, one that we have covered extensively on the channel during this time. And there were many reasons why this company was in fact down significantly. It couldn't catch a break, not even on one day. We saw that the CEO left abruptly. All we were told was that it was for personal reasons, which does raise a lot of eyebrows given the timing, and that they've also pulled their forecast for 2025. If you remember, just from their earnings, they did cut the guidance. Now they have in fact pulled it completely. And then the Wall Street Journal did release an exclusive article saying they are under criminal investigation for possible Medicare fraud, although straight away we got a response from UNH where they said they have not been notified by the DOJ of this, as they note here, supposed criminal investigation, and that they say the Wall Street Journal's reporting is in fact deeply irresponsible, and that they themselves admit that the exact nature of this potential allegation is completely unclear, and they say they stand by the integrity of their Medicare Advantage program. Now, as you know, on this channel, one thing we also like to do is look for opportunities where insiders themselves are buying up shares. And if you remember, the great investor Peter Lynch said insiders might sell their shares for any number of reasons, but they buy them for only one, and that is they think the price will rise. And that is something we have noted here on the 14th, 15th and 16th of May. We get directors, the CEO and the CFO buying shares, and we're not talking about a small amount. In fact, the smallest was around $94,000. Some of the largest buys included by the CEO on the 16th, $25 million, and on the same day we got the Chief Financial Officer, $5 million. Not something we're going to go into depth on this episode, but if you do want a bit of a background on the company, check out our early videos, and you could take this as a potential bullish signal. Now, also worth remembering that in 2025, only recently has the S&P turned positive, but what we have noticed, there are still many companies that are down deep into the red. Yes, UNH, as you can clearly see, down 42%, but some of the Mag 7, like Apple, down 16%, Alphabet down 12%, still haven't returned the poor fortunes they have had in just the last few months. And that is why today's episode is going to be very critical, where we are running through 12 overvalued stocks, and probably even more relevant as we are entering into extreme greed. This is where investors are getting very carried away, very bullish. They are very happy with the market, but we do also want to bring you back to around a month ago where we were sitting in extreme fear. And whilst it has 14, many viewers will know that we were sitting at low single digit around the 3 to 4 point. So sentiment can change very quickly, and also very important to understand what you own and why you own it. Now, just after the market closed on Friday for the week, and you could argue a very suspect in terms of timing for the release, but Moody's have downgraded the US's credit rating, where they talk about the issue being in the growth they have seen in the government debt, as well as in fact, as we can see from the Financial Times, a widening in the budget deficit. Now, for those that don't know, what they previously had was the top notch, in fact the best obtainable AAA credit rating, and this has now been lowered to what we see in the second place. So it is still looking fairly strong. It was in prime, now it has dropped into high grade, and who knows how the market will react on Monday, but just something to be aware of and potentially to track today and tomorrow. Now, the real focus on the episode, as we mentioned earlier, is identifying 12 stocks that we do believe to be overvalued. These are some very popular names that all in fact also pay dividends, and we want to discuss why we believe they're overvalued, and also, as you can see, there are many companies in the S&P that do look to be trading at some significantly high valuations, but also that is something we do note for the S&P on average as a whole. It's currently trading at a valuation on a P of around 28.4. Now, if you want to see where it was a little bit lower, you would have to go to October 2022, where it was sitting around 20 to 21, which was actually a fairly attractive buying opportunity. And we can see also, not in the too distant past, January 2021, where it was sitting as high as 36. Now remember, this is just the average of those stocks we have seen. Some are very high in terms of valuation, others are looking fairly attractive. But today we're going to flip the switch and we're going to take a look from the other point of view, overvaluation as opposed to undervaluation, which we do believe is fairly key. Now we're going to cover 12 stocks and AbbVie isn't going to be part of it. We just want to highlight how we are arriving at this conclusion. The first one is looking at the forward valuation, where it does sit above the 5-year average. For example, AbbVie 14.4 above 11.8, that would be one overvaluation signal. And another one would be here, the yield on offer at 3.56 is below their historicals at 3.98, another overvaluation signal. And we'll also show you a third aspect, and this highlights here the blue tunnel, the expected fair price. But what we see for this company is that it does trade above even the upper end. Again, another overvaluation signal noted. And whilst we aren't looking at AbbVie, we can see for at least over the last 12 months, this is one that does look to be consistently overvalued. So the first stock we're covering is Visa, and before we get into these companies, we do want to first highlight a few things. Some of these we do own in our own portfolio, Visa being one of them, but what we're really trying to say is we don't believe they are a buy right now. We're going to discuss for each one why that is, our own valuation and intrinsic price, but worth reiterating, these aren't ones that we believe are bad companies, just the valuation does not make them a buy at current prices. Now, as we can see, Visa up 30% over the last year, year to date up around 16%, and over the last 10 years up 424%, outperforming the S&P, and right now does trade at a new 52-week high as well as an all-time high in fact, and we only get one buy rating, that is from Wall Street, with both Seeking Alpha and Quant calling this a hold. But as we can see, the forward P of 30.4 does sit above the 5-year rolling of 27.6. Remember, as highlighted for AbbVie, this would be an overvaluation signal. Likewise, the yield they are offering of 0.65 does sit below 0.73, two overvaluation signals. And we get our third one here. As we notice, it is now sitting just outside of the upper end. 3 overvaluation signals for Visa, a company we love but just doesn't look like a buy now. In fact, if you were adding it around the period between July to September, where it was sitting below the blue tunnel, that would be what we would call an undervaluation signal, and this is what we do identify on this channel. So if this interests you and you are new to the channel, then do hit that subscribe button so you are notified when we do see some strong undervalued companies. Now we'll also run through 2 other things before our own valuation, the first one being growth, where they get a B-. Now revenue year on year and forward looking fairly consistent around the 10% mark, which is above the sector comparison in the mid-single digits, and is in line with their own 5-year, again around the 10% mark. In terms of EPS, they are anticipating growth of around 13% over the next 3 to 5 years. That is above the sector at 9.62, but in fact below their 5-year at 15.6. And finally, always great to see green when we look at the earnings. Over the next 4 quarters, they do anticipate growth to the EPS. Not only that, in fact, each one double digit, whilst also maintaining a 100% historical track record, either in line or outperforming analyst targets, and they're trading based on September 2026 numbers on the EPS at a forward P of 28.7. Now, intrinsic value for the company gets to $379 derived from the DCF model. Now we'll highlight how we got there. We have the free cash flow year on year, average growth 17% over the last 10 years, but moving forwards we have gone for a target of 10%, but bear in mind we have a low, medium and high 8, 10 and 12 respectively, and numbers are subjective. You can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for Visa or any others. But based on the growth rate and the discount rate, we get to the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and 379, indicating 4% upside. Now, full transparency will show you the other rates at 8%. $328, essentially telling us downside of 10%. So if you don't believe they can increase their free cash flows at even 8%, this one is seemingly very largely overvalued. And for those that believe 12% is more appropriate, then you can see upside, whilst limited, does sit at 20%. So what we're going to do, as typical on the channel, is take through the medium rate. Where we're not done there, we also want to show you the appropriate margin of safety, using 10%, executing, buying on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, in today's episode for the company, it is a buy at $341, which isn't where the company sits now. If you're looking for a 5% margin of safety, again, this purely highlights Visa does not even have a 5% MOS. It does sit around 0 to 5%. Again, will depend on whether you even want an MOS for a company, but we would typically say minimum 10%, which should be a buy at 341. For those that want 15, 322, at 20% around 303, and at 25 around 284. As we said, no margin of safety, trading not far off their intrinsic price with an MOS around the 0 to 5% level, and Wall Street, even with their buy rating, see this at 383 over the next year, upside of 5%. As always, give us your thoughts as we go along the episode today. Now, before we continue, we just want to let you know we have released our latest free weekly article. We draw on every single Monday morning to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of May. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of 19 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next company we're covering is the Hershey Company, which is trading at $162. It's down 24% over the last year. Year to date, down 6.5%. And over the last 10 years, it is up only 65%. They have had issues with rising cocoa prices, and as we can see, all-time high $275 we're talking 2 years ago, and they're trading towards the lower end of the 52-week range. And this really highlights the point: just because a company is trading near its 52-week low doesn't mean, in fact, it is cheap, doesn't mean it is a buy. Just something to point out, with every single analyst, Seeking Alpha, Wall Street and Quant, calling this company a hold. And we also notice the forward P of 26.8 is sitting above the 5-year at 23.9, an overvaluation signal. However, we can in fact highlight the yield on offer at 3.5% is above the 5-year at 2.1, so this is what we would have to say is a potential undervaluation signal, and that is why we never look at any of these models in pure isolation, and we get confirmation of that overvaluation when we take a look, as it is sitting above the upper end of the blue tunnel. And what's interesting, the actual blue tunnel has been decreasing over the longer term. That isn't something you want to see. That means each share is worth less over the last year, and this is ultimately the opposite. What we want to highlight are companies that are actually increasing in intrinsic price. With the stock price decreasing, that is where we do find value. And maybe no surprise then, with their growth grade sitting at an F, year-on-year revenue down 6%, forward-looking very mediocre at 2%, with the sector looking marginally better around the 2 to 3% point, and their own 5-year highlighting that this company has been increasing their revenue at a much faster historical rate. And something that's even worse is they anticipate earnings per share over the next 3 to 5 years to decrease by 3%, when the sector sits higher at 6 alongside their own historical numbers. And earnings per share, just to really top it all off, over the next 4 quarters, each one is anticipated to be negative with a 50% track record, and we can see forward P estimated to be around 25 in December 2026. Now, intrinsic price gets to $168 as the average of these 3 models, and when we do talk about margin of safety for this company, you're not getting 10%, you're getting pretty much bang on 5, which we would say is nowhere near enough for this company with the issues it faces and the lack of growth. For those that just want to see 10%, 151, at 20, 134, and at 25, 126. But right now, 5% margin of safety, real lack of growth over the next year at $165. Wall Street themselves see upside of 4%, but we would like to hear your thoughts if you do particularly disagree. We then move on to Starbucks, which is actually up 14% over the last year. Year to date, down 6%. Over the last 10 years, fairly similar to Hershey, up around 68%, with their all-time high, July 2021, $126, and we see it trading towards the lower end of the 52-week range. Some similarities to Hershey as well, just one buy rating from Wall Street, and we notice their forward P 32 above the 5-year at 29, but they do in fact offer a yield of 2.9% above the 5-year of 2.2, so two slightly different contradicting signals. But we can see here, in fact, we do get that overvaluation. It is outside of the upper end of the blue tunnel, whilst also the thing we don't want to see is the expected price decreasing over time. These are things just to highlight, just to bear in mind for when you do come to your own investment thesis. And grading for the growth also very poor at a D. We're seeing negative 1% over the last year, 3% over the next 12 months. We can see the sector is still very low, in fact around the 2 to 3%, but over the last 5 years they themselves have been increasing their revenue around 7 to 9%. And EPS not looking too great at around 8.2 when you consider the sector sits at 10.4 and their 5-year growing a lot faster at 14.4, and only 2 of the next 4 quarters are anticipated to grow with another 50% historical performance. Also September 2026 forward P not looking great at all, 28. That does purely in isolation seem very high, and our intrinsic value of $82 pretty much given the current price tells us we believe it's trading at a very small premium, although not far off the intrinsic price. For those that do want a 10% margin of safety, a buy at $74, at 15 at $70, at 20% $66, and at 25 $62. So in our own opinion, Starbucks is trading around its fair price. Wall Street themselves, even with their buy signal, see this at $94. That is upside of only 11%. But let us know, maybe this is one you do believe is a strong buy and can really perform a lot better than what we have seen in their last earnings, which has been fairly terrible. We then move on to Dell Technologies, which may be a bit of a surprise, down 22% over the last year. Year to date, pretty much flat. Over the last 5 years, outperformed the S&P, up 161%, trading in the mid to lower end of the 52-week range with a triple buy rating from Seeking Alpha, Wall Street, and Quant. This was one we actually covered that looked like a buy when it was trading around the $80 mark, but right now we get that double overvaluation signal, forward P 12.3 above the 5-year average, as well as the yield on offer 1.84, slightly below the 5-year of 2.28, and again confirmed from this model that the company is in fact trading outside of the blue tunnel. But we do notice it was trading in fact below not too long ago. That would have been a good time to consider, where we would have said that to be an undervaluation signal. But nice to see, unlike what we have seen from Hershey and in fact Starbucks, the expected price has been increasing over the longer term. Growth coming in at a C+, now year on year and forward looking around the 8% level, which is marginally above the sector at around the 6 to 7% point, and actually a lot better than their own historicals around the 3 to 1%. And also nice to see EPS around 12.4% is expected, which is a little bit lower than the sector at 13.5, but a lot better than their own historicals at 8.3. And always good to see green for the large part, growth expected in 2026, whilst also having a 75% track record, and their January 2027 forward P sitting just above 11. And our intrinsic value gets to $147. Now you will be getting a fair amount in terms of a margin of safety. In fact, it is sitting bang on around the 25% point. Wall Street themselves also anticipate upside of 17%. Their price target $131, but perhaps for this company that isn't sufficient enough to consider it, or maybe you disagree, 25% is sufficient and Dell is one to consider, perhaps one you can give your own opinion on. And then we move on to Walmart, a company that has performed very well over the last year and one that we do believe is a great one to consider for the long-term portfolio, but at these prices we don't believe is the right option. Up 53% over the last year. Year to date up 9%. Over the last 10, outperforming the S&P, up 289%, trading at the upper end of the 52-week range with just one buy rating from Wall Street, but we should make you aware 4.48, very near to 4.5 to flip this into a strong buy. And that is a massive disparity between the average of 24.4 and where it sits now at 37. So we would say severe overvaluation, and the same to be said here with the yield below 1% when the 5-year average has been 1.5. And we're not surprised at all that we can see this translated in this model. Massive disparity between the 2 points, one that has only been increasing over the last year. So this does look very clear that Walmart is trading severely overvalued, and growth sitting at a C- year on year and forward looking around the 4 to 5% point, which is a little bit above the sector around the 2 to 3%, but pretty much in line with their own 5-year averages. And if we look at EPS, they're expecting to grow at just under 8%. Again, a little bit better than the sector at 6.2, but also bear in mind the sector as a whole does trade at a much lower valuation, and we can see pretty much in line with their 5-year average. But at least good to note, green right across the board, trading in fact at January 2027 numbers at a forward P of 33.5, which also looks incredibly high. Now intrinsic value gets to $94, which we are in a very similar situation to other companies we have seen today that we do believe is trading pretty much around its fair price, although you are paying a little bit of a premium. For those that want a 10% MOS, buy at $84, at $20.75, and at 25% around the $70 mark. Right now though, no margin of safety, and Wall Street, even with their near strong buy rating, only see 12% upside, their price target $109. We then move on to JPM, but in reality we could have also incorporated within this Morgan Stanley and Goldman Sachs, all of which we do believe to be overvalued. It is up 32% over the last year, year to date up 12%, over the last 10 years, again outperforming the S&P, up 303%, trading at the upper end of the 52-week range, one buy rating that is from Wall Street, and a forward P that sits above the 5-year rolling, as well as a yield offering lower than what it has done historically at 2.62%. And also that is reflected when we take a look, it is outside of the blue tunnel, but you could have not that long ago bought it right at the bottom near undervaluation, and we can see the growth doesn't look that good at all at a D-. Year-on-year revenue 13%, a lot better than the sector at 6%, also above their 5-year at 9%, but when we look to the next 12 months, only 4%, which is lower than both sector and their 5-year comparative, and their EPS looking very weak at 3.6%, when in fact the sector, which is also trading at a cheaper valuation, does sit higher at 9.6%, but we can see that is pretty much in line with their historical norms, and their EPS also not looking that great over the next 4 quarters, only one of them to be growth, but they do have a very nice 100% historical performance with some very nice, in fact, beats, most recent one at 43 cents, December 2026, forward P 13.8. Now our valuation gets to $264, again following a very similar theme. We believe this one is trading right now at reasonable signal, fair price. Wall Street themselves agree as well. They only believe 1% upside over the next year with their $268 price target. But if you do want to see 10% MOS, buy at $238, at $20, $211, and at $25, $198. We then move on to Texas Roadhouse, which is up 14% over the last year. Year to date, up around 7%. Over the last 10 years, outperforming the S&P, up 447%. Trading at the upper end of the 52-week range, a double buy from Seeking Alpha as well as Wall Street. We do get the overvaluation with the forward P of 28 above the 5-year at 25, yield 1.4 below the 5-year of 1.8, and also confirmed when we see for the first time in a long time that we notice it outside of the blue tunnel. And whilst they have a growth rate of C, we do get a very strong A- on both revenue year on year at 15% and forward looking at 11%, well above the sector comparative in the low single digit, but pretty much in line with their own 5-year averages. And EPS not too bad, around the 11% point, pretty much in line with the sector, but we do notice it lower than their 5-year at 13.5. And over the next 4 quarters, they do anticipate 3 of them to be growth. Worth highlighting, 50% track record. Most recent quarter was actually a miss, although marginally by 6 cents. And December 2026, forward valuation of 25.4, and our intrinsic value $198, not that far off the current price. Again, you could say trading at its intrinsic price. 10% margin of safety would be a buy at 178, at 15 around 168, 20 159, and 25% MOS $149. Wall Street themselves, they actually see downside over the next year. They believe this company's share price will drop to $190, but as always, give us your thoughts below. It's very difficult to have an episode on overvalued stocks and not include Costco. This one very similar, the same patterns in fact to Walmart, up 30% over the last year. Year to date, up 12%. Over the last 10 years, nice outperformance of the S&P, up 614%, and it is trading pretty much at the upper end of the 52-week range. Just one buy rating from Wall Street. Forward P showing massive disparity, 54.5 with the average at 38. That is one huge severe overvaluation signal. The yield 0.51, again below the average at 0.71, and probably no one is surprised to note not only is the company overvalued with disparity, but this has been the constant theme over the last 12 months. But if in fact we do move this to the last 5 years, you do get to see around 2022 to 2024 it was sitting in a reasonable signal. Very rarely, if any, do we see this company sitting in severe undervaluation. And whilst they get an F on the growth grade, we can see year-on-year revenue and forward looking at 6 to 7%, above the sector in the low single digit, but a little bit lower than their 5-year at around the 11 to 9%. EPS expected 9% over the next 3 to 5, above the sector at 6, but a little bit below their historicals at 10.1, and they do anticipate growth into 2026 and the remaining 2 quarters of 2025. They missed their most recent quarter by 8 cents, but have a 75% track record, and they're trading 2026 on a forward P of 51.3, looking incredibly high. Now, intrinsic value gets to $707 derived from the DCF model. We can in fact show you we've used a growth rate moving forwards of 15%, which you could already argue to be very high, but this really reflects something very interesting to note, that even if you were to use a growth rate of 20%, you would see downside of 3%. So this company has a lot baked into it in terms of growth, but also worth noting, this is one that historically does trade at a very high multiple, but as we just saw over the last 5 years, it has on average traded a lot lower. Even using 15% though, really putting the point home that you are getting no margin of safety in quite a significant disparity between the current price and where we see this. For those that wanted 10%, again, just to highlight, you would be looking at a buy at 636, at 20 around 565, and at 25% around $530. Even Wall Street, with their buy signal, see limited upside of 6%. Their price forecast $1,082 over the next year, but do let us know your opinions. We then move on to BlackRock, which is up 22.5% over the last year. Year to date, down 4%. Over the last 10 years, marginal outperformance of the S&P, up 169%, trading at the upper end of the 52-week range. Just one buy rating from Wall Street, but actually not far from a strong buy. Again, both signals here pointing to overvaluation. Forward P 22 above the 5-year at 20. Yield also offering right now lower than the 5-year average. And again, confirmed when we do take a look at this model, although you can see not that long ago it was trading at slight undervaluation. Growth coming in at a C+. We do notice year-on-year revenue 14% and forward looking at 12, a lot better than the sector in the mid-single digit. And when we take a look at the EPS, expected a little bit of a disappointment at 7%, given the sector as a whole does sit higher at 9.6, and also only 2 of the next 4 quarters are anticipated to be growth, with the last 4 being beats and fairly sizable for each one of them, trading at 2026 numbers at a forward P of 19.8, and our intrinsic price of $874, although not to the same extent as Costco, does show disparity between where the 2 levels are, meaning we see this trading at an overvalued level quite significantly. At 10%, a buy at 787, at 20% around $700, at 25, 656, but as we said, trading at a fairly large premium. Wall Street themselves, lack of upside of 4%, they see this at just over $1,000 over the next year. Continuing on, we have Nike, which is down 31% over the last year. Year to date, down 17%. Over the last 10, up 21%, trading towards the lower end of the 52-week range. Again, just one buy rating from Wall Street, and we see a large forward P of 38, given the 5-year average is lower at 33, still does look very high as an average, but you are getting a high yield of 2.5 given the 5-year sits at 1.1. But we do get something that is very poor to note. Not only does it sit outside of the blue tunnel at the upper end, but also the expected price has been coming down and very sharply in just a matter of months. Growth also very poor, negative 7% year on year, negative 4% forecasted, given the sector is positive even at the lower digit end. And we do see over the last 5 years, on average, they've been increasing around the 5 to 6% mark. And EPS projected very trivial, 2.6%, sector a lot higher at 10.4, again one that trades above in fact the sector on purely valuation, and we can see their own 5-year sitting a lot better at 12.9. Earnings also looks very poor, only one of the next 4 quarters to be growth with a 100% track record, and trading at a forward PE in 2026 numbers at 30.4. What's interesting to note as well, the forward PE actually increases because they are estimating the earnings per share to actually lower from 2025 to 2026. Definitely something worth highlighting. And our intrinsic value of $79 does in this case, very rare today, give a margin of safety, and as we keep on going you're getting bang on 20%, but there are a lot of issues. Probably makes sense to need a larger MOS. At 25 a buy at 60, at 30 around 56, and at 35 around $52. As we said though, not at 25% just yet, you're getting 20% with Wall Street themselves, pretty similar in terms of the price, $77, they deem upside of 22%, maybe one to consider, maybe one you also believe overvalued given the economic climate around the company. We then move on to Cisco, which is up 32% over the last year. Year to date, up 7%, over the last 10, has underperformed the S&P, up 117%, trading at the upper end of the 52-week range, with a double buy from Seeking Alpha and Wall Street, but Seeking Alpha fairly weak, 3.5 is the minimum needed for a buy rating, and we get that double overvaluation signal, both on the forward PE as well as the yield currently, and again reflected when we do take a look, all 3 signs pointing to Cisco being in an overvaluation space. Growth also looking terrible at a D-, year on year, barely even 1%, forward looking 1.5%, the sector sitting in the mid-single digit, and their own 5-year, in honesty, is looking very poor around the 1 to 2%, and EPS only expected to grow 4.6 when the sector looks a lot higher at 13.5, and their 5-year only a little bit better at 5.1. Although great to see green right across the board, and we can see July 2026 forward valuation of 15.8, and our intrinsic value gets to $61. Again, constant theme, pretty much we see this trading around its intrinsic price. No margin of safety, but if you wanted 10%, a buy at $55, at 20 around 49, and 25 around 46. Wall Street themselves do see upside, 13%, their price target sitting at $71, but as always, give us your thoughts. And then we move on to Occidental Petroleum, one that Warren Buffett holds. In fact, he just added again in his portfolio, one of his top holdings, but if you are buying it now, you're buying it less than his initial purchase price, down 32% over the last year, year to date down 13%, over the last 10 years down 44%, although bear in mind this is if you had bought 10 years ago today. For example, if you bought the COVID lows around the $10 mark, you would be up more than 4 times, trading towards the lower end of the 52-week range, a buy just from Seeking Alpha, hold from Wall Street and Quant. Now we do notice the forward P sitting at 16.7, well above the 5-year 12.9, but the yield on offer does sit much higher at 2.2 with the 5-year below 1%. But we do actually get it confirmed here, the overvaluation, as well as that signal we never like to see with the expected price in a downward trend. And their growth does come at a C+, year on year 2%, but over the next 12 months, negative 1.5%, with the sector in the low single digit, and over the last 10 years they have been growing their revenue at a much faster rate. Although great to see, EPS expected growth 14% over the next 3 to 5, above the sector at 10 and well above their own 5-year at negative 0.6. Also worth highlighting, they sit in a cyclical industry, so we do expect sometimes for it to be good in terms of the numbers and others to be weaker. Over the next 4 quarters though, each one double-digit decrease to the earnings per share, 100% historical track record, trading on 2026 numbers at a forward valuation of 13.7, and our intrinsic price gets around $50. Wall Street themselves see this at 49 over the next year, indicating 14% upside, and our MOS at 10% indicates a buy at $45, at 15% pretty much where we see this company now. But as always, give us your thoughts. Maybe you do disagree, not just with Occidental Petroleum, or in fact you believe some of the others we have covered are a strong buy. Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.